Hey, I'm Matt Usher with Ray Williams and Associates. Just wanted to do a nice little overview of the small to medium-sized business market options when it comes to health insurance. So, if you've seen any of my videos before, you know that we predominantly work in Georgia, mainly working with businesses with 15 to 20 employees, all the way up to 250 employees, and we're constantly running across those types of businesses that are frustrated, they're confused, and they really just feel like they have a total lack of options. And depending on who they've been working with in the past, maybe they've been conveyed a message that there just aren't a lot of options. But the reality of the situation is, in today's time in the employee benefits world, there's more options today than ever. So over the last couple of years, we've kind of put together some pieces to help clients and prospective clients understand all their options. Today, I just want to take some time and go through each of those in greater detail so that you can have a better understanding of what your options may look like so that you don't feel helpless when it comes to your health insurance renewal for your employee benefit plans. And if you do feel helpless, then obviously I want to be a resource for you. So what you're looking at right now is just a chart that we put together, and we're going to go through each part of that chart in greater detail. So we'll start off with ICRA. So ICRA plans have become more and more popular over the last couple of years, and I anticipate that they will continue to become even more popular, especially in the small business market. So what ICRA means is individual coverage health reimbursement arrangement. So an ICRA plan is still an employer sponsored plan, but it works with individual health insurance plans. So each individual employee would have their own health insurance policy. And what that basically means is the employees would go out and pick their own plan. And then the health reimbursement arrangement, that's where the employer would actually be providing money in a tax advantaged way to the employees so that they could then get reimbursed for the premiums that they spent on their individual coverage plans. So, like I said, these are going to become more and more popular. And I think the reason that they haven't really blown up and become the preferred type of plan for small businesses is because there are still a couple issues that you have to work with. So let's talk about kind of the good and bad of ICRAs. The good is individual plans are pretty affordable depending on what market. I know in Georgia that market is a lot more stable. So instead of having 20% increases like what we'll talk about later, you get a lot more minimal increases, like maybe just a couple percentage points from these plans year over year. ICRAs will work in an arrangement all the way down to just one employee on the plan. And most of these individual markets have a lot more plan options. So because you are going with an individual plan, now your employees could choose from all the plans that are available in that market. Versus if you were on a group plan, you might just offer your employees maybe one plan, two, three, or at most maybe four options. So in Georgia, currently there's about 154 on exchange individual plans. Obviously, that varies by what county you're in, but also you can take into account off exchange plans as well. So you could really be giving your employees the opportunity to pick from maybe 200 plans or at least over 100 plans, depending on where they are. The downfall to these plans, in my opinion, and the reason that they haven't really taken off is a lot of the individual plans use very small HMO networks. So HMO means there's in network only, there's no out of network coverage, and those networks are traditionally a lot smaller than the HMO plan that someone might have had many years ago. So not only are they restrictive locally, but many of them don't allow for access to care outside of their home state as well. And for a lot of people, that can be really challenging, especially when you're in like a border area where you may have care in one state, but you may frequently get care in another state just from a convenience standpoint. Or a lot of people that like to travel or might come from other areas. And with COVID, people have really moved all over the U.S. Sometimes they still use providers, where they used to live, just from a convenience standpoint. So that's one downside is the networks. I do believe that if those networks improve significantly, then ICRAs would be all over the place. But until that happens, I think that's one of the stumbling blocks. The other thing is they have really high out of pocket maximums, and most of the plans are not really ideal. So if you're a business that traditionally had richer plan designs, a lot of these individual plans are going to have much higher deductibles, $6,000, $5,000. Those are kind of the normal deductibles, but then their out of pocket maximums are also going to be in the $9,000 range. So, again, from a plan design, not really ideal. They do still have gold plans, so they do have richer plans, but even some of those gold plans will have out of pocket maximums of 7,500 or more, which is not ideal when you're comparing it to a rich group insurance plan. I would say that probably the last downside to it, in my opinion, is if you want to have an ICHRA be administered by a third party administrator, there's additional fees that come into play. So not only are you paying for a portion of that employee's premium, but now you're paying another service fee to help administer that ICHRA. So that could be, $30, $40, $50 per employee per month. And that's an additional cost that you don't really have today in the traditional group plan model. So that can make it cost prohibitive. Certainly, if you have only a couple employees, you probably don't need a plan administrator. But if you've got 15, 20, 25 employees and they're picking from 150 different plans, you're definitely going to want someone to administer the actual process and make sure that those premiums are being paid on a monthly basis. So that's a brief overview of ICHRA. So if an employer wasn't interested in ICHRA, maybe the network issue was a problem, or maybe they just wanted a richer plan, or they didn't want to have to deal with a third-party administrator to kind of make the ICHRA work, then they're going to be predominantly looking at the small group or the group plan option. So now we're going to go through those, starting off with the fully insured market. So fully insured just simply means that you pay your premium and the insurance company is on the hook for all of the claims after that. It doesn't matter whether you have $1 million in claims or $10 in claims. Your premiums are based solely on the age and the location of your business. So you're rated by the county that you're in and the age of everyone that's on that policy. These are also referred to as Affordable Care Act or ACA rated plans. So if your business has 2 to 50 employees, they would be ACA rated. If they have 50 to maybe 250, then they're fully insured. They're not ACA rated with the actual insurance company that they're with, but they are still manually and experience rated. So they are kind of governed by however that book of business with that particular insurance company is running. So you've got a few different dynamics there. One, unfortunately, the ACA market has become super volatile in the last couple of years. So these types of plans in the 2 to 50 market are generally the most expensive plans that you could offer today, because the dynamics of the market are many of the insurance companies are leaving that market, which is reducing the competition. And when competition gets reduced, premiums go up. So now we're in a state, specifically in Georgia, where it doesn't seem like any of the insurance companies really want this risk. And because of that, they keep increasing the premiums, but people keep paying for those premiums. So they're still staying in that risk pool, and the insurance companies still continuing to get bad risk. So the only way that they can get out of it is by actually leaving that marketplace, which we just saw that happen 2 years ago with Humana. Their plans are finally exiting. This is their last year of having any plans on the books. And now we're seeing that with Cigna Oscar, which has only been in the market for a couple years, and now they're already exiting as well. Both of those were done at the national level. So even though I'm speaking maybe specifically to Georgia, that's happening all over the U.S., any of those markets that Humana and Cigna Oscar were in. So the downfalls to the fully insured market are premiums are expensive. There's very few companies left that are even offering plans. They are ACA, Affordable Care Act compliant plans, so most of their out-of-pocket maximums are also very high in the $9,000 plus range. And for the past several years, it's been a 15 to 20% average increase. I do anticipate that to continue to probably get worse as competition shrinks. The last piece to it is really, as a employer, when you're in this fully insured market, whether you're 2 to 50 or you're in that 50 to 250 space, you're not getting any data from your insurance company. So even if you might have had 100 employees on your plan, you're lucky if you get a premium versus claims report from your insurance provider, or maybe a large cost claimant report. Again, doesn't really give you a ton of insight, very minimal data. If you're a small business under 50, you're not getting any data at all. So you really have no idea what is going on with your plan. You have no idea if the increases that you're receiving are justified. And at the end of the day, the increases that you're receiving have nothing to do with your actual experience. You're still being rated as a block of business with that particular insurance company. So this next little chart, just real quick, this was the 3-year history prior to 2014, just to articulate all those ACA rated plans were getting over 10% increases on average. This is across the whole state of Georgia. In our personal experience, most of those increases were in the 15 to 20% range. And that's why I continually reference that percentage when we're talking about year over year increases. So if you're a small employer, you want to keep offering insurance, ICHRA doesn't really work for you. The fully insured rates are just through the roof and the plan design stinks. What are your other options? And so your next option would be an association plan. The good thing about association plans is they allow you to get into what we call kind of a risk rated pool without taking on the risk that people may associate with a level funded plan, like what we're going to talk about shortly after this one. So, an association plan is simply just a plan that's being offered to a particular association. So, a lot of these associations may be industry specific, some of them might be market specific, and some of them might just be general associations that were created simply to come up with a better way to buy your health insurance. So luckily, we work with a lot of different association plans. Some are sponsored by major insurance companies. Some are sponsored by independent associations and third-party administrators. So it really runs the gamut as far as the options that we can bring to you. The association plans have pros and cons, just like any plan. So one, you need to make sure that you actually have access to an association plan. And we need to make sure that it's a legitimate association plan. Oftentimes we'll see association plans, but when it really gets down to business, it's just a regular small group plan as if you were on your own, no group buying power, whatever it may be, and typically the same premiums that you'd see in that ACA rated market that we already covered. So one, making sure you have someone that knows how to negotiate the association plan market and find all the plans that you would qualify for. So with association plans, it is experience based, like I said, or risk rated. So typically there's underwriting that's involved, and it's either going to be a really good fit for you or it's not going to be a good fit. But if it is a good fit, you're going to save money on premiums, and usually those plan designs are going to be a lot richer than the ACA market. The downfall to the association plan is you are experience rated. So if you are a really bad risk, you might get a higher than expected renewal. It's also rated on the actual association. So if the association is running poorly, you could potentially have a bad renewal. But the upside of that is if the association is running really well and you're running poorly, you could still benefit from a lower than expected renewal because the association is kind of carrying the weight on your behalf. But the other downfalls, in my opinion, are no data. So typically association plans aren't going to provide claims data. And then also no surplus, which I understand you don't really understand what that means at this point. But as we cover the alternative funded and level funded plans, you'll certainly have a better understanding of why having access to a surplus would be beneficial to you. The next best option for you to consider is going to be a level funded or alternate funded plan. These plans are going to be offered in a whole variety of ways. One would be through a major carrier, and the other avenue would be through a third party administrator. So we're going to break those down for you so you can get a better understanding of how each of those would work. In the major carrier level funded plans, when I say major carrier, I'm just talking about the same 3 or 4 insurance companies that you've heard of: Aetna, Anthem, Cigna, United Healthcare. All these carriers offer what are called a level funded plan. And if it does make sense for an employer, there's a few things that you need to understand. So before we kind of go through what the pros and cons are of these plans, let's talk about what a level funded plan is. I do have some videos on that if you want to recap and get a deeper experience for what level funded really means. All a level funded plan is, it's a partially self-funded plan design that's being funded at your maximum exposure. So you are in a self-funded arrangement where a portion of your premiums are being set aside to pay claims, but you're also paying for all the administrative fees that you need, as well as all the stop loss insurance that you need. So you're fully funding this contract, which creates a level premium because there is no fluctuation in claims. You're paying the same premium every month, no matter what. That's where the level funded premium comes from. Now, under that type of arrangement, you're either going to run at a surplus or you're going to run at a deficit because, again, you're paying the maximum amount expected. And if claims are less than expected, then you could have a surplus in your claims fund. If claims are worse than expected, then you're going to have a deficit in that claims fund. And that's going to come into play here shortly whenever I talk through some of these plan designs or pros and cons of those plans. So again, major carrier level funded, the same big four insurance companies that you've already heard of. These are going to be less expensive than a fully insured plan. If they make sense for you, it could be a really good fit because it does allow you to kind of dip your toe in the water of a partially self-funded plan. Most of these plans are going to feel just like every type of health insurance plan that you've had in the past. But one of the key benefits to this is a lot of these level funded plan designs are a lot richer in benefit than the ACA or fully insured plan designs that we talked about. The downfall is there is a limited surplus return. So a lot of these larger insurance companies, even if you were to run at a surplus, they're not going to give you all that surplus back. Some of them give you back half, some of them give you back 2/3, some of them give you back 1/3, some of them don't give you any of the surplus return back. And then the last piece would be depending on which insurance company, a lot of the data that you're going to receive is going to be somewhat limited. So it's good because you are getting data, but depending on what that carrier provides, sometimes you're not getting much more than just premium versus claims. But with data, you are able to then make some actionable decisions when it comes to your renewal, and you're not just looking at, oh, here's another increase, and we have no idea why the premium went up. So if we thought that the concept of level funded made sense, but maybe we wanted to step away from some of these major insurance companies, then there's still plenty of other options that could exist for you. And these options come from third party administrators. So if you don't know what a third party administrator is, they're very popular in the large group, so the mega employer space, because most large groups are already self funded and therefore they're using a third party administrator to run their plan. So for a small business, a third party administrator would basically step in and they would become your health plan. So everything that you would call your typical health insurance company for today, you would now be calling a third party administrator. They would be helping you look up the network. They would be processing claims. They would be adding employees, removing employees. They would be coordinating with the pharmacy benefits. They'd be coordinating with care management or whatever other types of care or aspects that you may need within your plan. So they're going to act like your insurance company. And in a lot of ways, this is a really big benefit to a small employer because these third party administrators, they actually care about their clients. And when you call them, they're going to want to do everything they can to make sure that you have a great experience because they don't want to just write your policy and then have you leave them for another third party administrator, a year into the contract. They want to write that policy and they want to keep you for as long as possible. So within the third party administrator model, there's two different roads that you can go down. The easiest for a small employer is to go that major carrier network route. And what that means is, hey, we're using a third party administrator. Maybe you've never heard of them, but we're still going to use the big national network that you've been accustomed to, the Aetna network, the Anthem network, the Cigna network, the United Healthcare network, whatever network that is, we're going to still have that comfort of that big national network. But now we're using a third party administrator, so they're going to be scrutinizing and reviewing a lot of those claims a lot more in depth to make sure that we're paying a fair price based on those network contracts. The other benefit to these third-party administrators is a lot of them are going to give you back 100% of your surplus. So again, this isn't apply to all of them, but many of them will give you 100% of your surplus back, and they'll even give you your surplus back if you don't renew with them, which is also a huge benefit because not a lot of companies will do that. You're typically going to get more robust reports. So a lot more in-depth reports on not only the medical spend, but the pharmacy spend. And then we also want to point out that when you're using a third-party administrator, you have a greater opportunity to work with what we would call a transparent prescription benefit manager. So once you go down this road of becoming level funded, you're going to start to see things in your data. And one of the things you're going to see is just how much money gets spent on pharmacy claims. And the only way to really combat the rising cost of pharmacy claims and all the kind of insider trading and behind the door deals that happen in that market is to work with a transparent PBM. You can't do that with a major carrier company because most of those major carriers own their own PBM. And naturally, the more the PBM charges you, the more money you make. But that also means the more money that your employees spend on their drugs, and also the more dollars coming out of your claims fund for those drugs. So we want to work with an independent PBM because we want to try and minimize those costs and also take advantage of any rebates or any other type of opportunities to reduce the spend, not only for the plan or the employees. So that's really important and one of the main reasons why we're big fans of third party administrators. The second road that you can go down in the third party administrator world is reference based pricing plans. So these plans are definitely not for everybody, and there is a little bit of a learning curve. But once you've had experience with being in a level funded or alternate funded plan design, you will eventually get to a point where this is another lever that you want to pull. So with a reference based pricing plan, we essentially eliminate the networks. Some of them will still use, a provider network as kind of like your base network, but we're no longer paying claims based on a negotiated rate between some big network contract and the provider or the facility. With a reference based pricing plan, you're actually paying claims based on some type of reference based price compared to what they are paid, what those providers and facilities are paid as it relates to Medicare. So, again, the savings can be really significant because using one of these big name insurance networks could mean that you're paying sometimes 300%, 600%. So, six times what Medicare pays for a particular surgery or particular procedure, you're paying that just because you want some big name network. Whereas with a reference based pricing plan, you're going to be paying a lot less than that. So, it's going to be a lot closer to what Medicare reimbursement is for those procedures. And those dollars can add up significantly. Again, it's not for everybody. Once you have some claims, you'll start to realize what that impact could be. But the other great thing about using one of these reference-based pricing plans is it's pretty easy to implement direct contracts, which if you have a high concentration of employees in a particular area, a direct contract would then allow your employees to get care directly with a specific provider or provider group, and there would be some type of capitated or discounted price for those surgeries. So this could be like an imaging center. You may be able to come up with a direct contract with that imaging center where your plan or you specifically are paying them a fee for your employees to use that facility. And then in return, because of the discount that you're getting on that fee, you could then turn around and say to your employees, hey, if you do need imaging, if you go here, it's free, right? Or if you go here, it's only $100, or whatever contract arrangement you want to come up with. But you can do that contract arrangement with all aspects of care. You just want to make sure that you're doing it with kind of the most common or the most frequent types of claim spend so that you can actually make a big impact on your cost. So that is in general an overview of the whole market and all of the options that are available to you. One of the reasons that we try and work with employers in this smaller market segment to help them understand they have more options than ever is because you really do have a lot of other options, and you need to be working with someone that's going to talk through all these options with you. They're not all going to make sense for you, and they're not going to make sense at a particular time and place. There is a different time and place and strategy for each of these. So it's important that you just understand them. And that way, when the time comes for you to really strongly consider one over the other, you have that foundational knowledge about what type of plan or arrangement you want to get into. At the end of the day, we're just trying to give our employers more control, reduce their costs, keep their costs affordable, but by reducing their costs, we want to help them increase the control over their plans. And as we talked about today, there's not a lot of options in that fully insured or ICHRA model that allows an employer to control any cost. So it's really these level funded and alternative funded plans where you can kind of embrace control, make your plan as rich as you want to, but still keep it affordable and give your employees access to great benefits at an affordable cost out of their paycheck. That's all I wanted to cover. I hope you were able to learn something new, and I really appreciate you watching the video. Have a great day.